A couple months ago, I made a few videos talking about how I would approach valuing gold. And in both of those videos, I basically concluded that gold was deeply undervalued compared to where its market price should be. This is one of those charts that illustrates the divergence between my gold valuation, which is highlighted here in blue, and gold's actual price. Now, at times, such as during the peak of gold's bull market in 1980, as well as in the peak of gold's bull market in the early 2010s, both my valuation model and the gold price converged and became more or less one, signaling that gold was appropriately valued. But then for broad, long swaths, periods of time, there would be a divergence where gold would be undervalued to where I think its market price should be. And ever since the pandemic has hit and the government shutdowns were instituted and the Federal Reserve started engaging in massive expansionary monetary policy, monetary stimulus, and the government engaged in massive fiscal stimulus, we've seen this divergence between my gold valuation model and gold's price reach a huge crescendo. And I'll post a link in this video under the description of that original valuation model. So if you wanted to get more details about how I approached and valued gold and where I think it should be, you can watch that video in that description to give you kind of a better contextual idea here. And before I continue, if you like the content that I provide, make sure you just click the like on this video, show me some support. Subscribe to my channel if you haven't already. Click the notification bell so you're notified whenever I upload a new video. And as always, when you're finished, just drop a comment. Let me know what you think about all this or any kind of questions, or if you need any kind of clarifications. I'd like to know your thoughts on this. In any case, I've always been baffled by why gold has had this huge divergence. I mean, in my mind, more or less, when you have good markets working together with good information being communicated, we should be seeing proper valuations more or less accurately predict price. And it doesn't. It does not. So the question becomes, well, is the valuation model wrong, or is gold wrong? Is gold's price wrong? In other words, is gold being mispriced? Now, in the previous videos, I kind of show how gold was mispriced compared to the stock market and GDP, but there was one element of the equation that I was missing out, and I missed out on it on purpose because I did not know how to properly value it or to use it or approximate it into how it affects gold's price, and that is till today. And I think that it's one of the primary drivers that is actually mispricing gold and causes the divergence between gold's price and, say, stock market valuations, as well as stock market compared stock to GDP ratios. I think that this value, this identifier is what's causing stock markets to be overvalued and gold to be undervalued, because this market is being mispriced. And I think that's the core of what's going wrong in our economy and our investment markets today. And what I think is being mispriced is the corporate bond markets. I think corporate bond interest rates are unusually low, and that these ultra low interest rates are feeding into higher stock prices because the opportunity cost of owning stocks, that is, owning bonds with high interest rates, are lower, and also causing lower gold prices because the outflows of gold are flowing into the stock market. Now, typically speaking, if you've been watching my economic forces playbook video that I made, either a video or two ago, I've been telling you how interest rates should affect precious metals in the sense that lower interest rates should raise precious metals. So higher interest rates would push down precious metals because the interest costs go up. So the opportunity cost to owning precious metals, which don't pay any kind of dividend or coupon rate, goes up and therefore pushes that price down. But if interest rates go down, that should push precious metals up. That's true in a normal functioning market. But when markets are heavily distorted by either fiscal or monetary policy or both, or some type of government action or some type of external event such as a pandemic, then we can see markets go haywire and we can see the probability of mispricing in markets increase substantially. And I think that's what's going on in the bond markets. To put it succinctly, I think investors are flowing money out of the stock market, particularly in lower market capitalization stocks, but they're placing them in the bond market and they're not flowing it properly into gold. And I think that the reason why they're doing this is because they are counting that the effects of the pandemic, which is the bottlenecks, the supply shortages, the economic distortions, as well as the high inflation, are all going to be temporary and transitory, and things will shift back to a normal market environment when this pandemic is over. So they are giving the situation sort of the benefit of the doubt that this is just a short-term event, not a long-term event. I have reason to believe that in the coming months, that nature, that outlook is going to change, where investors are slowly going to realize, as inflation gets worse and worse and worse, that these effects, whatever the cause may be or causes, are not transitory. And so I believe what it's going to cause is outflows out of these bond markets and into the gold markets. Now, when you take a look at these interest rates, you can already tell that the interest rates on AAA, B-rated, and triple C's and lowers, that's your junk bonds, by the way, ultra high yield, lowest of the lowest grade in investment grade bonds, those yields are already lower than what they were pre-2020. But other than that, it's kind of difficult to gauge just how mispriced the bond market is. So I'm going to show you a couple of charts that really paint the picture of just how badly mispriced these bond markets are, how overvalued these markets are, and how distorted the interest rates are. And it may cause a snap back, especially with higher inflation, as well as the Federal Reserve inducing a tapering of asset purchases, which may cause a snap shift back of interest rates to pop back up even just 2 or 3%, and that could have severe ramifications in these markets and prompt bond outflows. Now, where are they going to outflow? It will most likely go into gold and silver, because bond outflows and rising interest rates already lower or raise the opportunity cost of owning stocks, yes, and then it also creates uncertainty as well as increasing the risk of credit defaults because of higher interest costs. So it is very probable that this will move into the gold market. First chart I'm going to show you is the real interest rates on AAA, B-rated, and triple C and lower bonds. You can see how for the AAA rated, which is highlighted in red, that more or less it moves along the inflation rate. So when you take AAA rated interest rates and subtract by the inflation rate, given a small premium of say 2 to 3, maybe even 4%, and then sometimes channeling down to 0, the AAA rated high-grade corporate bonds, the corporate bond yields, tend to flow right in tandem with the inflation rate, give or take. Now, there are times when they spike, which is in times of economic uncertainty, either during or right after an inflation, such as what we noticed in 2001 and 2002, as well as 2008 and 2009. And also with the popping of mini bubbles, such as the popping of the oil bubble brought on by fracking in the mid-2010s. We see a little spiking of interest rates here. Nevertheless, these AAA bonds tend to stay positive, even if only slightly positive. Well, look at what's happened in the pandemic. They're not positive, they're negative. And so what that tells me is that they are no longer pricing these bonds appropriately, because they take that these inflation rates are temporary, okay? So let me bring up my inflation chart right quick, my inflation table, and there's a chart that I want to show you about the longer term inflation rates, because I think that will spell out why these markets are behaving the way that they are. So I don't think that they're really pricing in 5.2% inflation rates. Instead, what I think is that they're pricing in the 2-year bond rate, or even the 5-year inflation rate, not the bond rate, but the 5-year inflation rate. And when you do that and you take those lower inflation rates and subtract that from this negative number, then yes, it brings it much closer to zero, okay? So they're not pricing in this 1 year inflation rate. Instead, they're kind of marking that off and going by a historical norm and saying, well, inflation for the past 10 years has been 2%. We'll go with that because this is an abnormal event, and that's what's causing these pricing of these bond yields to be so low and even negative. So in effect, investors who are holding these bonds and major banks who are owning these bonds are in essence taking a temporary loss because they think the losses are going to be temporary. Each passing month, the inflation rate does not go back to normal and instead builds upon itself. It's each passing month that these losses accumulate in real terms, and it's only a matter of time before we see this snapback, and this snapback could force interest rates up by a good 3 to 4% on these AAA bond yields. Now, when we take a look at the B-rated bond yields, we can see how they were nearly 5% going into the pandemic. They were over 4%, I'm sorry. Then they kind of spiked after the pandemic, and now they are more or less running alongside of inflation. So because of that, they are also mispriced by at least 4%, if not more, on that. And then when we take a look at the junk bond interest rates, they are the most mispriced of them all. They were priced at around, say, 10% on the bond yields going into the COVID, and now coming out of COVID, they're spiking around 2%. So when we take a look at how much of the U.S. high yield, just the junk bond interest rates, markets are going below the inflation rate, we can see that they are at the highest percentage of all high yield corporate bonds in the market today that we've ever since Bloomberg started compiling this data for the last 20 years. So typically speaking, high yield bonds have less than 10% of high yield bonds have been priced below the US CPI annual inflation rate going into COVID, and now coming out of COVID, 85% of high yield high yield corporate bonds are now priced below the inflation rate. That's going to change. That's not going to stay. That is an anomaly, and it is an anomaly caused by a severe mispricing of those bonds. So one of two things is going to happen. Either A, the inflation rates are going to snap down, which is heavily unlikely because we're seeing signs of supply shortages develop. The money supply growth rate is still high, and the historical trends favor a higher inflation rate of at least 4 to 4.5% year over year, and we're at just over 5% now. So it doesn't look like we're going to see much of an abatement of the inflation rates. And therefore, what we're probably going to see is a snap upward of bond interest rates and a severe pricing downward. So if we were to price these bonds compared to when they're going to correct, and this is just based off their trends of where I linked them historically before COVID, and then where I think that they're going to go after they correct, total correction. If we saw a full-blown correction in the bond market tomorrow, we're going to see where the AAA corporate bonds shoot upward by 4%, the B-rated bonds go upward by 6%, and the CCCs go upward by 8%. And if we were to price these bonds, assuming that they are 8-year corporate bonds and they just got issued today at these interest rates, and then all of a sudden we see the market interest rates correct, then these are what the pricing of those bonds would be. Now you got to remember, this is all of a sudden, if we saw it on day one, shift these corporate bonds to the correct price. This does not mean that we're going to see corporate bond prices tank by this much, because as we approach the par value on the yield to maturity, these bond prices will start to approach that par value price of $1,000, because that's typically what corporate bonds are issued at, is at $1,000 par value. But that being said, we could be looking at potential outflows of corporate bonds of upward to, say, trillion. Okay, $1 trillion flowing out of the corporate bond market because of the rollover of those on average 8-year corporate bonds, because that tends to be the average length of time that corporate bonds are reaching. And according to Financial Times, that's the longest length of time corporations have issued out bonds. They used to be half of that just a few years ago. Now they're up to 8 years. So it tells you how desperate corporations are to secure low financing cost funding and are willing to pay an upfront higher interest rate for the stabilization of a longer term fixed interest rate, because they're expecting that inflation rate to go up, or they're afraid that the inflation rate might go up. On the 10-year Treasury side, we could see an outflow potentially of up to $600 billion in Treasury bills, also because of the rollover of those Treasury bills, and that's assuming that we see the repricing on day one. In essence, I don't think that that's really going to happen. Instead, out of this potential outflows of 1.6 trillion, I think, and I'm just guesstimating here, we're going to see about 10% of that, and that 10% of that $160 billion is not going to just come out of the bond market tomorrow. This is going to come out over the course of months or even years. But even if we only see this much, we could see an adjustment of interest rates, especially as time goes on, upward by say, at least 2 to 3% on the average of these bond markets here. Now, when we take a look at the U.S. precious metals market, right, and we're assuming that the money that outflows has to go primarily into precious metals, because owning cash would be worthless inside of an inflationary environment and stocks would be priced downward. If they flow into the precious metals market, this is going to significantly increase the price of metals. The U.S. precious metals market is only $190 billion. It's a small market. It's pretty thin. If we got $160 billion coming out of the bond market, which is multiple times larger than the precious metals market, this is going to cause the price of precious metals to increase astronomically. In other words, we could see gold nearly double just from these outflows. This does not count the outflows that could come potentially from the stock market. This is just coming from the outflows of the bond market itself, okay? So if we saw those outflows go into precious metals, gold is essentially a sitting time bomb here. So is silver, and so are other precious metals like platinum. And if any of these money flows start to shift into that precious metals market, we could see a strong bull pattern run for gold to develop, and therefore gold would start to approach its real value. As a matter of fact, if we were to just put in that modifier and say, okay, well, what happens if gold did adjust from these bond outflows from interest rates, interest rates being priced appropriately in the bond market, then we can see here that post-COVID, gold now more or less adjusts much more closer to its market valuation, which is where I've been pegging that the gold price should be headed. Now, saying all this, gold's price should still be heading upward, and what's going to be the force that heads it upward? Well, it could be a correction in the stock market that could actually propel the gold the rest of the way upward, or even temporarily overshoot this valuation model. But more than likely, what I would see is that this valuation model would continue to be pressed up as inflation numbers continue to push upward, along with the money supply growth rate. So this model, this ceiling right here, is going to be pushed upward, and eventually so will those bond interest rates sooner or later, which will most likely outflow into gold and silver, press up the gold markets, and then we might get even a further boost in gold's price over time from the stock market outflow. So in other words, we're looking at a potential now of a strong bull market developing into gold, just based off of these situations that are coming upon with higher inflation forcing up higher interest rates. Now, going back to my economic forces playbook, I kind of indicated that, yeah, the quantity of effects that are economic forces affecting precious metals was more to the downside than to the upward. But I also stressed that it says it depends on the weighting of those effects. And I think the inflation increase will have a severe weighting, even though interest rates may move up, which will put overall downward pressure on precious metals. It will be counteracted because it puts downward pressure on every other investment market. And it may cause a squeezing situation where money is outflowing to cryptos, outflowing from bonds, outflowing from stocks, and there's only really one place to put it into that appreciates in value: gold. The reason why it hasn't yet is because gold for the past 10 years has been in a pretty much stagnant bear market, okay? Once gold starts proving that it can start clearing hurdles, it's going to start gaining price momentum in the technical analysis charts, and that's where the outflows are going to start pouring in. Now, when's that going to transpire? I don't know, because the psychology of investors is very hard to price in. It may be that investors may go into winter and say, look, we knew this was coming. We're still going to hold out. We'll wait till the springtime. So we may not see this going into the fall. Okay. On the other hand, we may see a panic develop where investors wake up and say, oh, wait a second, these situations are getting worse, not better. I better start buying some gold as a safe haven hedge. It could be a picture of both. It could be both situations. So we could be seeing sort of like a gradual increase in precious metals develop as we go into the winter season, as we go into the holidays, and then in the spring when pricing effects do not come down, or do not come down as much as the Fed has anticipated, could cause an outpouring into the precious metals market. I don't know which of those effects will take place. And then there's also the risk of credit defaults, which could of course reverse that whole trend situation temporarily, much like what happened in 2008. Yet it still could result in an overall longer trend of precious metals being pushed upward because of the instabilities that the credit market, the credit defaults would pour inside of the economic markets, namely speaking in stocks and bonds. So the winner here, I still think, is going to be precious metals. Cryptos are in a bull market right now. They've been pushing upward, and certainly inflation increasing is looking to press up cryptos. Same is true with the potential of a credit bubble burst. However, as I've stressed before, if interest rates start to move up, I've said this before, cryptos seem to behave a lot like the NASDAQ tech stocks. I believe that will put downward pressure on cryptos, but it may not necessarily put downward pressure on precious metals. So guys, keep a lookout on that. Place your investments accordingly and be prepared for the unexpected. The volatility is here, and I think we're going to see some volatility in the precious metals market, but it should be a volatility to the upside. That's all that I have for tonight. Tomorrow, I'm going to give you the inflation numbers as they come out. Remember my predictions on those, that I'm basically predicting that the inflation rate is going to hit somewhere around 0.7%, probably between 0.7 and 1.2%. I do think that if it hits at 0.7% or above, that's going to be bad news for markets. It's going to be good news for precious metals, but also keep in mind that investors may price in that the Fed may panic and start tapering earlier, but I think the Fed is still going to keep on their schedule of planning the taper in November, which should already be priced in to those markets, and so therefore should start pressing up those precious metals. So keep on the lookout tomorrow. I'll post a vid tomorrow night updating about that, and as always, I thank you for listening to this video, and I'll talk to you tomorrow.